Hey there, everybody. Welcome back to the Finding Financial Fitness Show. Back again with my co-host, Pei Chen. Pei, how you doing?
How are you today?
I am amped up from our previous episode of Velocity Banking. It was definitely a lot of fun, and so now I'm excited to continue with that. Just it's one of those days where everything just seems to be going, and now we get to do the fun stuff towards the end of our day, which I like to end it with this because it kind of grounds me and it reminds me
Mhm.
why I love what we do. And one of those is velocity banking because that concept of velocity of money has been huge for us. But I would say the more important part of it, because velocity banking and the velocity of money component is
Mhm.
great. But there's something, in my opinion, that's more important. That can create generational ripples, if you will, in a positive way. And so that's IBC. And so we had Chris Bay on from Life Success and Legacy. We had Mike Everett on from Life Success and Legacy. We're going to have Mike Kwong on, your husband, from Life Success and Legacy. But even the other guests that we've had on, although they might not be IBC practitioners, they are also IBC practice people. So we had people from PML, we had all in one, Adam talking about the all in one. He himself is involved in life insurance with IBC. So there's a lot of different ways that people use IBC, but the way we do it is kind of taking all of the individual isolated components and just bringing it all together and stacking and stacking and stacking, just all these different, because it is infinite, right? And that's
Exactly.
what I wanted to do today, and what the goal is to finish kind of what we did on the last episode, talking about the velocity of money and how we do velocity banking. And I kind of left it on a cliffhanger saying we were going to transition into IBC. I didn't want to introduce that concept at the end of the last show because I knew that it would spark questions. And there's a lot I know you could talk about, Pay, when it comes to IBC. So that's what I wanted to do today. So I'm going to go ahead again, as I mentioned on the last show. If you're not subscribed to the YouTube channel, please head over there, click subscribe, go watch this video on there, because you'll notice you'll get a huge benefit from seeing what we did last time. But also today, we're going to run through the remaining part of the presentation that Pay did. So I'm going to go and share my screen really quickly. Pay, can you see this?
Yes.
Okay. So
Awesome.
just really quickly, Pay, explain to us IBC, what you have here on this slide about the four benefits, misconceptions, or what we're looking at IBC for.
So just a real quick recap, right? When we had the interview with Chris Bay, he actually went over the four pillars of IBC real quickly. So IBC it's not a thing, it's not a product, it's not a company. It's actually just a way of thinking. It's a way of life, I like to call it. So the infinite banking concept, if at its very basic level, is just a way of interacting with our money in a unique way via the chassis of a life insurance product. And that product happens to be a dividend paying mutual life insurance, policy designed a certain specific way. Right. And how that's all designed and whatnot, that's, between you and your IPC certified coach, or what is it? Certified practitioner, authorized practitioner from the Nelson Nash Institute, since Nelson Nash was the creator of this concept, right? So he obviously has the authority to kind of teach this thing, and that was his vision, right? And all the people who are doing this practice is to kind of share this information with the rest of the world, because it's really something that once you catch it, like we have, it changes your entire perspective on the financial world, and also what we've been taught all our years, right? So in our previous episode, we talked about how, we've been taught to be a saver, right, in life, and how that kind of, hopefully whatever we shared broke that barrier a little bit for you to kind of be like, hey, there's something else out there that I'm not aware of. And IBC is one of those concepts, that is one of those hidden concepts. Actually, it's been around for a long time. Like all these companies that, are that we use to set up our IBC system with, they've been around for hundreds of years, to be honest, right? So it's nothing new. It's just the way that it's currently being used is new to the world. So,
What's before you kind of move on, what I wanted
yeah.
to mention, the one thing when I was reading uh Nelson Nash's book, Becoming Your Own Banker, which again, as we mentioned in the episode with Chris Bay, I think it was episode 10, I believe. definitely go back and listen to that. But one of the key things that when people always ask me about learning about just finances in general, specifically IBC, there's multiple books that I like to give people. And if they have no knowledge of finances, of course, one of the first books is Rich Dad Poor Dad.
Mhm.
But if they have some basic knowledge when it comes to finances, the next books that I would recommend are Becoming Your Own Banker by Nelson Nash, and then obviously your husband Mike Kwong's book, Dibs on Your Money. But starting with Becoming Your Own Banker, just wanted to tap on something really quickly. When I was reading that book, the one thing that stood out to me, and you just kind of reminded me of it right now, is the fact of how long these life insurance companies have been around. Just let this fact sink in. Life insurance has been around longer than the tax code.
Mhm.
Like it was grandfathered into the tax code because it's been around longer than the tax code. So if it's been around longer than the tax code, it's been around more than most investments that are out there, S&P 500 aside, and the stock market. But even the stock market has had a rebranding in the last 100 years. So I just wanted to interject that because that to me, I had to read that, I had to Google it. I was like, wait, hold on, is that true? And it is. And then hearing different people talk. So, all right, what are the 4 pillars of IBC?
So the way that most people are introduced to IBC usually is the whole idea of using it as a debt weapon, right? Because it's where we're leveraging the power of velocity banking. We can use this product as a line of credit that we get to control. It's almost like a supercharged savings account that comes with all the liquid assets to the cash value or the equity in that policy, to use it like a line of credit, just like you would if you had like a Bank of America or Wells Fargo line of credit, right? So, the concept teaches us to think more like a banker, which nobody, even if you have an MBA out there, what they're teaching you out there is how to be a worker, not to think like a banker, right? So the concept really is a training to become a banker, and it takes some time. It's not like overnight. So you start with, first of all, right? Most American, their first issue is not because they're not making enough money. It's because they have debt.
Mm.
We are so used to living like borrowing first and then paying it off, right? Because we live on credit, and that's just how society is. So first pillar or first principle is to use this to eliminate outside debt, meaning we're going to turn it inwards. We still have the debt. It's not like, oh, we wipe out, we don't have to pay these, right? We still have the debt. Let's say you owe, in the example we used yesterday, right? You owe like $245,000 between mortgages, car notes, student loans, and whatnot. But what if we can turn those payments that we were paying, Bank of America, whatnot, back towards our system and recapture all that interest and monthly cash flow that was going out the door? So that's the first pillar of IBC, right? And in order to do that, here's the piece that people forget. How do you, when you want to write a check, how much can you write? Depends on how much you have in your bank. And how do you get money in your bank? You have to capitalize your own bank. Right? Like you can't use what you don't have. You can't bounce your check, right? So that's kind of the first pillar is, first of all, you got it. You don't be afraid to capitalize. This is going to be your bank. This is going to be set up for you and for your future generations. So you set it up properly, set it up secure, and start using it, right? Don't just, it's not a savings account. You don't just let money sit in there. You need to start utilizing it, right? Anything you want to add on this first pillar?
Yeah. So I think you mentioned it's not a savings account. However, for people who are going through this transformation, because truly using IBC is a transformation, if it helps you conceptualize it better, you can use it as a savings account. Because more than likely, right, we're talking about there's tiers to where we're starting. We talked about the average American and how most people have debt, and they're not really worried about passive income because they're worried about clearing up their debt. And oftentimes, depending on the nature of their debt, we still do recommend to pay off their debt. But then the next tier up is people who have debt, but also have savings. I think this is also very common. People think I'm not going to critique whether or not this is the right thing, but people find it okay to have a car loan and a house loan, They have debt there, and I have those as well. I'm not saying they're bad, but then simultaneously they have a savings account, and the savings account typically isn't the same amount as the debt they have here. But by shifting that savings account into an IBC policy, that would be like the very first step. If you just want to park it there, that on its own is better than having it in a savings account, right?
Yes.
And that's where having the multiple uses of the dollar, because having it in a high yield savings account, assuming you're getting 4% for now a year, you can't borrow against that money and still have it make 4% a year. Whereas with IBC, you can. So although it's true, we don't want to treat it as a savings account, but if it helps people to get started on understanding, I'm just going to treat this as a savings account for now, you can do that. And then from there, you can turn the wind current and bring your outside debt into your IBC policy, and then use your policy to pay off your debt, which is kind of the next step to that, if that's what you want to do. And then from there, we go into the passive income creation. So that's the main point I wanted to touch on there.
For sure. Yeah. It's there's so many layers to this. So we're just
Yep.
touching on like the most important piece. So that's where, like, you want to get started, start from there, right? And then of course, right, the next step or the next pillar, once you start to think like a banker, right? And you realize that, hey, I need to start controlling my money rather than handing control, right, of my money to somebody else. You're going to start building a pool of capital, money, that now you get to control, right? The beauty of these type of policy in the companies that offer them is that once the money's there, they actually don't care what you do with it. They're not going to question you. They're not going to make you apply and have to give your FICO score and apply and hope and pray that you're going to get approved. It's your money. You're actually, because it's a mutual company that we're using, you're part owner of that company. So as the owner, you have first right to the money, right? They cannot refuse your request for a loan. So once you have that built up, right, that second pillar or second use of the IBC is that it becomes a warehouse. It's bulletproof in a sense that I want to kind of talk about. That is that it's, first of all, it's growing on a tax free basis, right? So it's tax advantaged. And there's no, like, once it's set up, they don't charge you an annual fee to maintain it. They don't charge you a service fee, right, if to transfer the money in and out, right? And when you do borrow against this, just think of your house. This is actually a good analogy to use. When you buy a house, you of course you put some down payment. That's equity, right, into your house. And as the property increase in value, as the market value increases, your equity grows and grows. Now you can go down to the bank and you can request for a home equity line of credit, right? That is that portion of the equity that the bank will allow you to borrow against, right? And this is exactly what that policy, is allowing us to do. Whatever the equity is in this policy, that's money that we can borrow against. And that kind of trips people up. You're like, wait, it's my money. Why do I have to borrow against? And this is where it's important, because don't you want your money to enjoy uninterrupted compounding? So we kind of talked about that penny doubled every day example. This is where it's applicable, right? Obviously, it's not doubling every day, but it's that compounding is happening in the background while you still get to use your money to do whatever you need to do, right? So that tax-free growth, uninterrupted growth, it starts to build up over time, right? So this is a part where the rethink your thinking of Nelson Nash's like principle comes to play. Because if you're stuck in your way, or if you're like, I don't know how to explain it, but like, if you're not able to have an open mind and be willing to realize that you don't know everything out there, and actually the more you find out, the more you know, you realize the more that you don't know.
Yep.
Right? So this is where, like, he urges us, right, as IBC users or practitioners in life, to rethink our thinking, right? You and I are actually we're not like insurance agents or anything. We are just users. We're power users, I like to say. Like we take these things and we kind of pick it apart and figure out like the best way to use it and the most efficient way to use it. So we like to take it to the next level. And that's what we like to share with people, right? It on this very basic level, it can be treated as a supercharged savings account. Wonderful, right? And it comes with fringe benefits that a simple savings account won't offer you. But the next level is if you're able to kind of get out of your own way and rethink your thinking. And now that you have a pool of money under your control, now it's where the fun begins.
Mm-hmm.
This is where we love being in this quadrant. This is
Yeah.
actually echoing the cash flow quadrant from Rich Dad Poor Dad.
Yep.
I don't know if we mentioned that book before. Well worth the read. It's kind of, you got to move from square to square as you develop your skill of using this concept. Anything you want to add on this part?
Yeah. So I just going to the 4 pillars, and I know people will by this point will have kind of skipped ahead and read all 4, which is totally fine. I love the word bulletproof because going back to what I like about IBC and where I like to start with IBC is you have to look at the alternatives. So no matter what you're doing, you're already doing something, right? So even if you're not making any actions, that inaction is still a form of action, right? So if you just have your money parked in a savings account, you're doing something. You might not actively know what you're doing. You just didn't think about it and put your money into a savings account. This is allowing you to, when you have an open mind and are able to rethink your thinking, you're putting that same pool of capital. You're not adding anything new. You're not getting another job. You're not having to sacrifice your lifestyle. You're just pivoting from over here to over here. It's just a lateral pivot very quickly. By doing that, you don't even realize the power of what you're doing until you fully understand it. So I always, and this is not always the best advice for some people, but I always just say, do it and then figure out why you're doing it later, right? And I'm not saying this is the case for everybody, but it's not just, trust me, I'm the expert. But when it comes to this, even if you have a basic understanding of it, even if you're only on the first pillar of understanding why it's beneficial for eliminating debt, in the meantime, even if it's just a small policy relative to your income, that you're better off than where you are to the alternative, which is just parking it into a savings account. And then in that
Or
time,
risking it in
or
100%
risking it,
in type of investment, right?
or
Because that's
even a
what
quote
we're taught
unquote
to
safe
do.
investment, like a
Mhm.
bond, right? You might be thinking, well, I'm going to put it into a CD. And we saw what happened with Silicon Valley banks and how bonds started plummeting as a result. You're completely correct. It's not only are you improving the quality, but then you're also hedging your bet against the risk. You're making it bulletproof from external factors. So you have more control. And even again, like I mentioned, even if you just want to stop there, you're already better off than where you were. You've already gone from 0 to 1.
Yeah.
But typically, from what you've known many more people than I have, but typically from the people that I've met in IBC, once it's like an avalanche, right? Once you get that ball rolling, you realize this whole new world of possibilities opens up. And then you start exploring. And that's where we get into the passive income creation, where this is, in my opinion, when you start an IBC policy or policies, most people will take the same initial path coming in. It's either most of the time it's I want to eliminate debt and I want a place to store my cash. And there is variability to that, but for the most part, there's one entrance into the museum, if you will. But once you're in and once you have money in there, now you have the fork. Now is where the infinite comes in, because now you can have so many possibilities of what you want to do. And there's literally something tailored to every single person out there because you're the one designing it. Therefore,
Yeah.
it's made for you.
And Nelson actually says this in his book, right? And he used an example of some school children doing some math, problem solving things. And ultimately, the word infinite here refers to that imagination, right? As a kid, we have boundless imagination. We're not limited by what we're taught, but once you understand how IBC works, and if you are willing to awaken that inner child of yours and that creativity, wow, right? There's the both of us, we just love to like meet up and run scenarios and what if, and if you're willing to ask those questions, this is super fun. At least I find that it's to be super fun. I'm an
I agree.
IBC junkie. But ultimately, I also want to bring up that, I put down here this inflation proof, and people are like, how could this be inflation proof? Just like when you buy a property, a real estate piece of real estate, actually IBC has a lot of similarities to real
Yeah.
estate. When you buy a piece of real estate, right, rental house or whatever, what you're doing is actually you're inflation proofing your money, right? Because even if you're making a 30-year mortgage payment, guess what? Your mortgage payment today with that same dollar, you're going to be able to just keep the same payment for 30 years. You're buying something that's going to cost more with less dollars as you go, right? So that's where the inflation proof kind of comes into play, because if it's properly structured, your payment or premium deposit, as they like to call it, will never go up, right? So as our dollar gets worth less as it goes into the future, our asset continues to grow in a compounding method. Your dollar essentially kind of is insulated against huge inflationary period like we currently are experiencing today. So passive income creation, this is our favorite part, right? We, because of how easy it is to leverage these lines of credit, it gives us flexibility and control that we can leverage our cash value and put that into whatever assets you love. And of course, we're always word of caution, invest wisely and do your due diligence on the investment portion, right? Because all investments comes with a level of risk. Some people like to just, bet it all on black at the casino. And some people are more meticulous and careful with their money when it comes to investments. But this is almost like it's an insurance policy on your money, so that you can go out and do the bold actions that you want to do. Open up that business that you want. I did, right? I bought a franchise using a cash value loan from my IBC policy. I didn't have to go down to the SBA and ask for a loan. Can I buy this franchise? No, I said, I like this franchise. I believe in what they do. This is what it costs. I wanted to just go ahead and do that. I don't want the burden of having to pay the SBA loan back, and right, because when you start a business, first couple of years, you're not going to be cash flowing. So I didn't want that pressure, right? So it allowed me to do things that otherwise wouldn't be able to do if I didn't have this pool of capital available to me, right? I love real estate. I don't like what comes with real estate, right? The renter, the roofs, the rats, the toilet. I don't like any of those things, but I like real estate because I like things that I can touch and feel. So I leverage my cash value and I do, invest into real estate through the velocity banking method that we talked about yesterday, right? So I try to recycle this money over and over again. Some people like
Uh,
crypto. Go ahead, but that's pretty much, you're limited by your imagination on this.
a Nelson Nash quote that I love is, those who have the gold make the rules, the golden rule, right? And in this case, you mentioned buying a business, you mentioned just going into deals. When you have cash, you have control. When you're dependent on an SBA loan to go buy a business, a mortgage to go buy a house, you are beholden to the rules of the lender giving you that money. But if you are the lender giving yourself that money, you make the terms. So what Nelson always talks about in the book is, what's the biggest risk of life insurance and of IBC failing? You.
Yep.
Because while IBC is designed to give you control, that can also be its downfall if you don't know how to control yourself.
Yeah.
So keep that in mind. That's both a good thing and a bad thing. Just like taking it a step back to a previous episode we did with Dr. Teresa Ye, we had a couple episodes ago. You need to understand your why You need to understand your personality. You need to improve upon yourself. Working on your mental health and working on your just you as a person, understanding yourself will allow you to make more complex decisions. Because while we're talking about this from a financial standpoint, IBC isn't just a financial tool. It is a life improvement tool if you know how to use it. Because trust me, from experience with Pei and myself and plenty of people we've known, it's a headache to go out there and have to provide documentation to a lender for a real estate purchase or for a business purchase. When you can control at least one variable, and we're going to get into either later on the show or on different shows about how you can control both sides of the equation. Oh boy, do I have a strategy for you of how you can live stress-free and have the closest thing to guaranteed on both sides of the equation if you want to. So I'm just kind of previewing dibs here, but having the gold, you make the rules. And I think that that's very important. And what's the Spider-Man quote? You know, with great power comes great responsibility, right? Keep that in mind.
Absolutely.
Keep that in mind. That's why there's a saying of that's why Pei has at the bottom here, be an honest banker. If you're going to go get a loan, a mortgage for real estate, and you're going to go make monthly payments, you're not just going to stop making those monthly payments that you would have been. You're just going to pivot and recapture the interest that you would have been paying to the mortgage company to yourself. So now you have a real estate property that's just hedging all the bets against inflation, like Pei mentioned, but also you have the bank set up as well that you're recapturing all the interest and all the growth of the policy simultaneously. And the last pillar, which to me is the most underrated pillar of IBC. And I'm speaking from experience here because I myself don't necessarily have a family that I'm wanting to pass it on to at the moment, but I have friends, I have charities, I have people in mind that this is going to go to. The guaranteed wealth transfer is huge. It's huge. Because typically if you have kids, if you have family members you're passing this on to, typically you're going to pass on the knowledge, but then you're also passing on the concept, and then you're also passing on the bank. So it's literally an all-in-one. You're passing on the tools to goodness. If somebody would have given this to me when I was born and when I started and coming up, like it alleviates so much of the stress of having to figure out life on your own. This is great. So I'll close on the pillar, then I'll let you kind of touch on it. But the tax advantage death benefit while you enjoy the living benefits, I think that's such a good representation of it. And most people don't get into this for the IBC components. And for me, when I heard the term think long term, I wasn't thinking about, think about kids and all that. I was thinking more about, okay, well, I need to capitalize my policies. And it's not until maybe year 5, year 10 that I really, really get to reap those major benefits. But this is even beyond that. When it comes to the wealth transfer, you're passing this money on tax-free to whoever it is you want to pass that money on to. And there's something to be said about that and how you can set up your family.
Right. And this actually, to be honest, is a tool that a lot of the very wealthy families use and utilize for generations already. So here's a book that kind of talks about this. It's called What Would the Rockefellers Do? Right. So if you are familiar with the history of between the Rockefellers, like during that period of time, all the railroad and all the people who are very, very wealthy, right? But the Rockefeller family versus the Vanderbilt family,
Yep.
right? Their outcome, right? One family was able to maintain their wealth, and then the other family pretty much boom and bust, right?
Yeah.
And why? What made a difference was actually the practice of this, right?
Yep.
And it wasn't written down for generations. Like nobody wrote this down. It's almost like this fable that passed from generation to generation between families that I know. And finally, like Nelson Nash wrote the book and shared it. Like he didn't patent this, and that was intentional. His goal was to share this knowledge, just like we are doing today, with the rest of the world, right? And however you want to take it, if you want to practice it or not, doesn't make me, any better, or you don't personally benefit from sharing this information. But it's so good and so powerful. It's a shame not to let the world know. Especially, this is not available in most of the other countries. This is only just for like people in the US. Some Canada can do that as well, but it's not available worldwide. Like we are so blessed to have this tool, and like the population don't even know about it. That's what gets me all the time.
Not only that, I don't even think it's just the fact that the population doesn't even know about it, but even just telling the population, it
Mm.
takes a certain level of mental clarity. You have to be in the right space of mind to accept this information, because it truly is like, it is life changing. And people might come across and say, well, you guys are being dramatic. It's just money. I promise you, this is much more than a money concept. This is a life concept, the disciplines required to maintain and grow a policy are the same disciplines required to maintain and grow your health, to maintain and grow your relationships. There's such a crossover between everything, and IBC just happens to be the foundation of everything that we tend to do in our lives. There's not a day that I go by, and I know I'm speaking for you here as well, Pei, where the IBC concept doesn't come into my mind when I'm making a small little purchase or planning my next 5 years. IBC is central to that. And this next slide, we touched on most of these advantages already, about similar to the bank's line of credit, how we're in control. I mentioned with recapturing our interest if you're getting a mortgage or an SBA loan or any type of loan, that money goes out, that interest and those fees and all that go out the door. But if you can charge that to your own bank, that comes in the door, and then that's consistently passed down. And again, an additional source of cash flow. And like we just mentioned, creating generational wealth. And for me, it's not about the money. It's about what you're able to teach to others, mainly being your immediate circle. In our case, we have this platform that we can share it to others as well. But there's
Yes, when we talk
so
about
many.
wealth, we're not necessarily talking about dollars, right?
Sure.
Because I can I can pass a check to my daughter, that's great. But if I don't pass along the strategy and the thinking and the discipline to be able to handle that money, that check is going to be gone. She's going to have a wild,
Yep.
like 1 year is
It's gonna be
easy.
a wild year.
It's going to be a wild year. All her friends are going to be very, very happy. They're going to have a lot of fun. And then she's going to go back to work, and hating her life, right, a year later. So that's not the intention. The intention is I'm passing down the wealth of the knowledge, and I'm
Mhm.
using my daughter as an example, but like by us doing this podcast, we're hoping to pass down this wealth of information to whoever is listening out there.
Yep. And so now that we've covered the advantages of the
Mhm.
IBC and what we know about IBC, we talked about the 4 pillars. I want to I want to take one column here, which is the passive income creation, which is I think what most people are going to want to get into, the kind of depths of it. So I'm gonna tie this now in to what we talked about on the last episode with velocity banking. So we're gonna go back a few slides here to this passive income stacking, as we mentioned, because what I think is really important to note here is look at both the left side and the right side on this column. We're talking about the line of credit. So again, in this scenario that we talked about on the last show, we mentioned the line of credit on the left side coming from Bank of America, Wells Fargo. And while we said we're not paying that much in interest, we are still paying some money in interest, which if we can recoup some of that into our own IBC system, great. That's one benefit. Second benefit, Pei, you've experienced this and so have I. Sometimes lines of credit can go bang like that. Or I had a line of credit through American Express. And I remember 1 month they sent an email, hey, by the way, next month your line of credit's going to be half. No, no rhyme, no reason. And what can I do? Well, I just have to accept it. Now with the
Yeah.
IBC policy, every year that I fund my premium, my line of credit goes up. And typically maybe not every year, but every few stacks that I'm doing, my line of credit is also going to go up. So right away, I've eliminated and also thought long term about how my line of credit will continue to grow. Because although we did a few stacks and we went a few years into the future, the plan, if you're following velocity banking, is not for it to stop. It's going to just continue to grow. And eventually, which we didn't talk about, you can live off of the income coming from your stacks. Now, it's not as simple as a one-to-one of, okay, I have 5,000 coming in and 5,000 going out, therefore I can stop working. But there is a connection there of when you can start peeling off and living off of that. So now we've touched on the left side. The fun part, really the fun part, well, that's already fun. But the really fun part is when you can now turn the right side into using IBC, using principal and interest amortized notes. And that's where DIBS comes in. So that's where, again, I refer back to DIBS on your money, of how we can use our life insurance policies to cash flow both sides of the equation. Because
Absolutely.
if we have a policy hole, and I'm going to tease it a little bit, when we fund our cash value, or premium, sorry, the cash value that we have, typically we're either going to keep it into the policy, but if we're keeping it in the policy, more than likely we're using it as a savings account. We want to get that ball rolling. So what we're going to do is we're likely going to take that out, and maybe you go buy a real estate property with it, or maybe you do a down payment, or maybe you put that money to cousin Vinny. Well, now you've created a hole in that gap. But what happens to the base of that policy? What happens to are you taking money out of the policy? No, you're borrowing against it. So that policy is still growing year on year on year. And it's growing 3 to 5% guaranteed every single year. Well, if it's growing by that every year, in 3 years' time, which is 36 months, well, it's grown by roughly, on a minimum, 9%, 10%. Well, what did we say we needed every single amortized note? We were doing this at 6%. So can you not use your policy at 10%, take 6% of that growth, of the future growth, to then fund your amortized note? And what did we just say? Your IBC policy is going to be guaranteed. Now, I know if you're just hearing this for the first time, this will be a lot. This is definitely, it's not as simple as just, this is where coaching comes in. This is where absolutely valuable coaching comes in to understand this concept. This is taking it to the next level. This is where coaching is very valuable. But this just goes to show that I can control the left side and I can control the right side. And therefore, if you really wanted to make this as passive as possible, that's what you would do. That's truly what you would do. But some people, like when I first started out, and even to the extent I still am, Pei, I know you still are as well, we like to have some control. We like to have some excitement in our investments. We like the higher returns, because while IBC it's guaranteed, it's also not the highest return out there. We can go out and get something way higher and way crazier and way more speculative, but with that comes more risk. And please listen to our previous episodes that we did on talking about our conservative nature versus you have to know your investment strategy. Are you more conservative? Are you more aggressive? What's your starting point? Do you want to go to Vegas and put it all on black? With IBC, you have the option of doing any of that. And for some, that's actually the downfall, because they are not being told what to do. It's up to your discretion on what you can do. So just keep that in mind, but also know that there's things on the spectrum of the most conservative, which I would put this there, to literally going to Vegas and putting it all on black. Like, you could double your money in 10 seconds. I don't know of any other deal that you could double your money in 10 seconds if you really get it well. But also, you can lose your money in 10 seconds. So keep that
And
in
we
mind.
also talked about the barbell investing, right?
Correct.
So just keep that. If you go back to and listen to, or there's the book you can read about what that essentially is, right? You can actually do this, because we're doing it with a income stacking way. You can actually take a little bit, especially once you have the IBC set up, it actually affords you to take a little bit more higher risk on your investing part. Because why? Because the underlying policy that we're using this with, that money is, like I mentioned, is growing tax-free, uninterrupted, like you never ever took the money out of the policy. You literally don't, right? Because when you borrow against these policies, it's actually the insurance companies fronting you that money. They're looking at, okay, Johnny has this policy and his equity in this policy is X dollars, and he wants a loan. They're not interrupting that growth. They're letting that money continue to earn whatever 5-6% dividend that the policy is doing. They're then saying, like, let us front you the money, but we're using your policy as a collateral. In case you don't pay back, we are using your life as collateral. You are the
which
asset.
you're
You
gonna
are the
die.
asset. Yeah.
But
Two things guaranteed in life: tax and death.
and
Right?
if you don't pay your taxes, death is guaranteed. No, I'm kidding. No, and it's because people sometimes, I get it. I did this as well. When you want to understand, when you're learning something so novel, you want to understand the mechanics. You old people, we've been taught, especially in our American culture, to be very, very cynical. Okay, well, what's in it for them?
Mhm.
How is the insurance agent making their money? How is the life insurance company making their money? This is too good to be true. Because that's, I'll tell you again, when I read that book, it's the first thing I thought, this is too good to be true. What's the catch? I was waiting for it. What's the catch? And if you're learning about it and you go and Google it, you're going to find a lot of people saying a lot of different things about IBC. Some are correct, but taken out of context. Some are incorrect because they just fully don't understand it. And it's not to say that this is the only way. By all means, if you don't, again, Pei and I are not getting anything out of this. We're not selling you. We're not saying, hey, here's the referral link. Like use our code. Like there's nothing there.
Yeah.
It's just, this is a practice that we've used, we've mastered, and we just want to share that with people because it just gives you another lens to look through. And the more opportunities, the more options you see, the better. So going back to what I was saying, people have a tendency to dissect it because you want to understand the mechanics. And that's what I like about Nelson's book, is that he explains the why. And quite simply, people in the life insurance world that are on the opposite end, the ones that are giving out the life insurance policies, the big companies, they know you're eventually going to die. So if you don't pay, if you take out a policy loan, let's say your cash value is $100,000 and you take out a policy loan for $50,000 and you put it into a real estate deal, and the real estate deal, it goes south. You lose all your money and you still owe the insurance company, your own bank, $50,000. What happens if you die? Well, now you have a death benefit associated with that, and your death benefit is always going to be greater than your cash value by a pretty significant margin. So let's just say your death benefit is $1 million. It's going to be more than that if it's 100K in cash value. Let's just say it's $1 million. Well, then what are they going to do? They're going to take that $1 million that would go to your family tax free, and they're going to subtract the 50,000 that you owe from that $1 million.
Mhm.
Simple as. So now you're not getting the $1 million. You're getting $950,000. Simple as. Like that's it. And then your family still gets the benefits of it. And even if you had your cash value loan completely maxed out, okay, but you just take that cash value away at $100,000, they're still getting $900,000. Tell me that that's not going to be enough money to weather the storm of your passing. God forbid something happens sooner rather than later, but it's eventually going to happen.
Yeah. And it's, again, I always like to use a piece of real estate as a comparison in that scenario, right? So you buy a house, you get a home equity line of credit, you max out on that. Let's say your home is worth $1 million. This is 30 years down the road, but let's say your home is worth $1 million, and you took out a home equity line of credit of $500,000, right? And you happen to jump out of an airplane and parachuting, and you die, right? So what happens to your family?
I love how that's the example that
My imagination is wild.
clearly Faye.
So you're gone, right? It's very sad for your family, but what happens? Your family, as your estate, can basically sell the house, right? And you're not going to get a whole $1 million, right? You're going to have to satisfy that note, that HELOC that you took out, right? And you spent all that money. So now they're going to subtract the $500,000 from the sale of your house. And actually, with a real estate, you have to pay, realtor fee and all that kind of stuff. So after that, then they subtract what you owe and you get the net difference. But with the policy, simple, they just calculate what's your current death benefit as of today and subtract what you owe on them, right? Whatever interest you owe. And then the difference, it's a check. Your family receives a check. No questions, right? So it's that simple. But a lot of misinformation is out there, like, oh, what happened to my, cash value? Well, you took out the money, you got to use it, right?
Mhm.
So you're not going to get the full death benefit, even if you have already used up all your cash value, right? So that's just what you owe the insurance company for fronting you that money. And this is one thing that I think gets repeated, and I hear this from Mike all the time when he talks about this, which I wanted to introduce this here to the audience, is that when you look at these type of policies, look at the last line, that death benefit, on that policy. That's what's the future worth of your policy is going to be, right? And it actually keeps growing. This is just as of today, when you first look at it, when your agent presents it, when you look at the last line, that death benefit, that's your future worth of this policy, right? What people don't realize is that the cash value, because of the way that these policies are designed, the cash value is just a current um, portion of that future death benefit.
Mm.
That cash value eventually, if you were to live until 121, whatever year old, that policy, if you do Nino's program and you live a very long life and you outlive your policy, that policy is like a CD. It matures at that death benefit amount. They cut you a check for the whole entire amount, right? Minus whatever loan that you have taken out already, and that's yours. So that cash value catches up. It's just a present day value of your future death benefit. So that's how cool this whole thing is, right? It's a self-collateralized system, and you can actually see what you're going to get in the future already. There's no guessing. It's guaranteed to be there. So that's just, it always blows my mind that they just kind of focus on the first year. Oh my God, how much am I going to get out of this thing? I'm losing money the first year. I'm like, okay, you got to look at the last page. The last page of that illustration, or the last line, right? For people who like, let me just wait another year to do this. Guess what you're losing out? You're not losing out on the initial years of the compounding. You're losing out on the last year of the compounding, right? That penny double every day example, for the first like 15 days, it's like, ugh, why am I doing this? I should have taken the $1 million upfront, right? But once you hit that, I think that the 15th, 20th day, that's when you just surpass, you blow through the $1 million. And by the 31st day of that compounding, you're looking at like $5 million, right? So that last line is actually more important than the first line.
And the more you keep putting it off,
Mhm.
the delay, the penny doubling starts. It's that simple.
You can never skip the first years. You can't.
If someone asked you, would you take $1 million now or double your penny every day for 31 days? And your answer is, let me think about it. Now you've lost on both fronts,
Mhm.
right? Make a
That's right.
decision. Like, of course, understand, learn it, understand it, but you're only going to get older. So you're delaying the start of it. And God forbid something happens to your health. There's the other element of you need to qualify for these, right? They're not indefinite things that you can just go out and get $10 million worth, because my goodness, that would make our lives easier if we could. That's where we're at now. Once you understand these, you go very quickly from the question of, do I really want this, to how can I get more? It's like a drug addict. You have your first taste and you just don't want it to end.
Well, let's just do a tally, right? As of today, personally, I've been doing IBC. I've incorporated IBC into my life for about 11 years, almost 12. Scary, but for about 11, over a decade, right? And over the decade that I've been involved in this, as a small family, it's just me, my husband, and our daughter, we have a total of 14 policies,
Mm,
right? And I'm not saying that they're all huge policies, right? The earlier ones, when we were just getting started, we were younger, our income wasn't as high, so we started where we could, right? It was a little bit of a stretch, but we made it happen, right? It's almost like you got to be a little bit uncomfortable when you're doing this, because if you're not uncomfortable with that amount, then you're not doing it right. You
I
want
remember
a big check, right? You want a big check in the future, then you got to write a big check today.
I remember when
Um,
Chris mentioned that on the show, what
mhm,
he was making as a salary teacher, and he leveraged over 60%, not leveraged, but he used 60%, over 60% of his income in policies. You
mhm.
talk about trusting the process and believing in the system. You got to put your money where your mouth is ultimately. And that's where, go back to what we've said before about our guests. We don't bring on guests that we've never done business with ourselves and actually dealt with. Just like we're not going to talk about products and things that we personally haven't not only fully invested in. There's things that you and I have done that we wouldn't even discuss on the show because it's like a 1% or 2% of our portfolio and we're kind of waiting for it to play out. We're talking about the larger concepts that we live by, that we swear by, because we've seen it work day in and day out, and we've been through the hurricanes, we've seen all these crazy things, and we're seeing what is working. What I did want to finish up on, and we'll do kind of a sneak peek into this, and I just wanted your 5 minute spiel on it, because one of the biggest things that I had when I was getting into it, and that people ask me as well, is, all right, I understand IBC. I'm going to start my first policy. I have my first policy. I'm going to get multiple policies. The next question then becomes, what do I tackle first? My debt or passive income? And this is one of those questions, in my opinion, that is very similar to asking, is it better to have a low carb diet or a low fat diet? To me, that's very equivalent. Nonetheless, it's a very relevant question because it doesn't alleviate the question, doesn't alleviate the problem that's underlying the question, which is basically, where do I start? So I'm gonna pitch it to you, and I'm just curious about your take. We don't have to run too long with it, but what do you think? Do you tackle debt or do you go after passive income first?
The beauty of the DIP system and the velocity banking way is you can actually do both. When you tackle debt, the way that the passive income, if you go back to the slides and whatnot, you look at it, right? What are you doing when you're investing? You are taking your money and you're lending to somebody else with a promised return, right? Well, a hopeful return. I don't want to say promise because unless you're doing dips, that return is not promised. It's a hopeful return. When you use the passive income stacking way and you actually purchase out or buy out your own debt, like I was showing in the debt elimination example, remember how I was able to use $6,000 of a line of credit to wipe out the $6,000 of credit card that I owe and then free up about $250 of cash flow? Isn't that income? Discipline comes into play, right? You can't take the $250 and then start buying, handbags and stuff, right? You got to use that $250 as, you got to treat that as cash flow coming back to you. That's guaranteed cash flow because you're the one that was making that payment to somebody else. So actually, in a sense, I'm answering your question with you can do both. Why
Hmm.
can't you do both? Right? I'm not saying to do all your stacks as debt pay down, but I'm just saying maybe you can start with, hey, let me wipe out these expensive credit cards and let's turn that wind current first and recapture those dollars. And then once I'm able to pay off that leverage, the line of credit, which possibly is your other, policy. If you have two policies, you could use the one policy for the line of credit and one policy as, a debt absorber, right? You could actually run that scenario and be able to do both, right? So it's not a simple answer as one or the other. The way that we do it, you could actually benefit from both sides of the equation.
Yeah. And my answer is the best answer to any question. It depends.
I knew you were
Answer
going to say that.
everybody hates. And here's why. It depends on the nature of the debt.
Mm.
And that's something where I think a coach is valuable, but also somebody who has some experience. There's debt calculators out there that will tell you how much your debt is. A lot of it comes down, there's multiple factors that come in. How early on are you in that debt? Because it's the earlier you are on, the more, especially as a mortgage, and if it's an amortized note, you're more than likely paying your interest high on. Again, Mike has this in his book, Dibs on Your Money. It's a beautiful amortization calculator that shows your first 5 to 7 years how much you're paying in interest and how much you're paying in principal. However, most people starting out, let's say they have a $300,000 mortgage and your line of credit is $6,000. That $6,000 line of credit, flipping it into your mortgage, you did the calculations, you showed it on there. It's going to take a long time to tackle that debt. So typically, and especially if you're planning to move soon, but typically in that scenario, it's okay, we'll go ahead and let's pivot towards passive income and let's build up that stack large enough so that, because again, this will keep going indefinitely. And if you have more into the income and the input, you're going to grow it a lot faster. And eventually you can get to the point where you can chunk down part of your line of credit to pay off your mortgage. And that's the best way to do a stacking split, a split stack, whatever you want to call it, where you're going both ways and addressing it. However, there is the other side of it where if you have expensive debt, as you've mentioned, and again, as Mike's mentioned in the book, where you're paying 21, 22% on credit cards, well, that by just freeing that up, you're going to free up a lot in cash flow. So just look at the two examples on the mortgage. If I take the $6,000 line of credit and apply it to the mortgage, that's not going to free up cash flow. It's not going to free up cash flow until I pay it off. Right. And we talked about that's going to take years to pay that off. Yeah. But if I pivot that 6,000 and I pay off a student loan or a more expensive debt, such as credit cards, and I have a $5,000 Amex credit card out, and I am paying $250 to that, and I free that up. Well, now I've just increased my cash flow by $250. You need to look at what's known as the time effect of money. The sooner you can get started on something, the better, but you want to make sure you're strategically doing it, because if you're chunking down your mortgage and you're not freeing up cash flow as a result, leave it. You're going to pay it regardless. Leave it. Go for the things.
It's like a very emotional thing. It's an emotional decision. Yeah.
It is.
So what I have learned right now, I actually have 3 mortgages, believe it or not, right? Craziness. But if I have 3 mortgages, one of which is my primary residence, right? And I'm like, okay, do I chunk down my mortgage or not? And this is one trick that I've learned I'm willing to share is I will never chunk down the mortgage of the house that I currently live in. And the reason why?
Hot take.
I can't cash flow this property. I live here. Unless I'm willing to get 5 roommates to live with me, I'm not going to cash flow on this.
Wait. What about the money you would be freeing up from the payments you're making to the mortgage company? So let's assume your monthly payment, principal and interest. We're not talking taxes and insurance, because taxes and insurance you're going to pay regardless.
Right.
Let's say your principal and interest is $1,500 and you pay off your home. In theory, it's not going to cash flow more than the payments are, but in reality,
you recapture the dollars.
You recapture the $1,500 there. No,
but I'm just saying that would be my last one. Like if I have 3, right? Currently I have 3. This is my life example. I have 3 properties. One is a short-term rental, one is a long-term rental, and my own primary residence, right? And I have a finite amount of income in dollars, right? And I'm doing my
you're on the wrong show.
So I need to be like a surgeon and be precise on how I use my money, right? So I'm not going to throw dollars to this primary residence where even if I pay it off, the most I can get is just, free up my monthly payment to the mortgage. And that's going to take years to get there. Versus I can look at the 3 mortgages that I own, which one do I cash flow the most and owe the least on? Do that little calculation. And I'll rather divert money if I have to pay down a mortgage, I'll divert money to pay off that one so that I can then increase my cash flow. Once I pay off that home, I can do an all-in-one loan on it, so I can still recapture all the equity to do whatever I need to do. Think about it, right? And on top of that, I can then use the cash flow to service that debt and have additional cash flow coming back to build up my stacks. Crazy. That's why I would not pay my primary residence home mortgage first.
No, I think that's brilliant. And it goes back to strategy, which goes back to personality traits. Yeah. And because you could realistically, and I mean, just you and me both having this conversation 2 years ago, it was, I'll take I had, to give people context, I had more debt than I had assets, yet I was cash flowing a good amount of money monthly. So in a traditional finance world, people will say, well, what's your net worth? And if your net worth, because your net worth is your assets minus your liabilities. And if you have a home and your house is worth 500,000 and you have a mortgage of 400,000, your positive net is
Yeah,
$100,000.
yeah.
Your net worth is 100,000 there, and your other assets. But yet I was able to have more debt than I did in assets, but my cash flow monthly was high enough that my cash flow was super positive because my assets were paying more than what my liabilities would have been paying. Right. So that's where looking at assets versus liabilities is so important, and why looking at solely your net worth can be a little bit deceptive. And I want people to be mindful of that, because we can get tricked into it. So
Yeah. And that's why we actually talked about that in the last episode, where we're talking about that, what does financial freedom really actually mean, right?
yeah,
That's
yep,
when your passive income from your investments coming in, right? Your mailbox money surpasses or meets or surpasses your monthly expenses, right? That's when you get to actually have options to do what you need to do or what you want to do with
yep.
whoever you want to do when you want to do it, and wake up late for a business meeting and still be okay and not be fired.
Well, we'll talk about that offline. I'm kidding. No, and again, everybody, this is, you're starting to see. So we finished up on IBC. We finished up on the introduction of, we had talked about IBC in a very general sense when it came with Chris Bay and just introducing that. Now in this episode, we talked about IBC in a little bit more granular, but also as it relates to velocity banking. And then we're finishing up with velocity banking, talking about how you can go to different strategies. And again, these are just some of the strategies. There's things that people have come up with that works and fits their niche. Like that's for them. But again, why I go back to the premise of the show and why the show is laid out the way it was is because if you're doing all these strategies, again, speaking from experience, if you're doing all these strategies without having an end goal in mind or just doing it for the sake of doing it, you're going to get to a point where you have all this cash coming in and you don't know what your number is. You could have maybe stopped 6 to 9 months ago, but you were so focused on doing this crazy aggressiveness that you never even realized it. So it's important that you identify your goals, you identify your why, and now you can start learning about the different and the various strategies. And as we keep going in these episodes, we're going to challenge. Our goal is to challenge our listeners here. So, all right, you got this. This is a little bit complex. Velocity banking and IBC. All right. Well, how can we then mix in the all-in-one? Pei very, very, very easily mentioned it slightly of how you can throw the all-in-one in this mix, but that adds even more cash flow if you factor in the all-in-one with your IBC, with your passive income stacking. And there's other little things that you can pivot. You can add in layers when it comes to traveling. You can add your points and miles in here. You can add strategically so many things in. And what's nice about it is you control that. You determine the rules and you determine how much you want to do. However much effort you want to put into it, it's going to be what you're going to get on the outcome. So with all that being said, this is the fun stuff. This is where things get exciting and can become overwhelming. And if you need to go back and listen to previous episodes, re-listen to this episode again to kind of get that clarification, please do. But this is where we're going from now on. We're going to continue to have guests on who are going to continue to talk about new strategies, advanced strategies, and then how we're going to implement those strategies into what we're doing. And this is the fun stuff. This is what it's all about, Pei.
And on IBC, really read Nelson's book. And to some people, they really love the book and it's easy read. For me, it was a bit of a challenge. Me being ESL, it was a little bit harder to go through the whole book. It's only 92 pages, and I'm not really good with math, to be honest. So whenever there's like a table with a lot of numbers showed up, that's when I get lost. But just go through it really quick, even if you just kind of breeze through it. A lot of good concepts and wisdom in the book is worth reading, right? There's a lot of information on the internet out there. There's a ton of information, unlimited, but wisdom, very, very, very few and far in between. And Nelson's book is full of wisdom. So recommend that book. Number one, read Mike's book, Dibs on Your Money. It's kind of a follow-up, kind of a Cliff Notes of some sort. For those people who are like, I don't really understand the Black Book, then
Mhm.
read
Read the
Dips
white
on Your
book.
Money. That's going to help you kind of understand and summarize some of the terms in a more like a layman's way. And that's going to help. And then like kind of reinforce what we're talking about here with that whole velocity banking and all that. It's all good
I
stuff.
will also plug in here that Life Success and Legacy, they have their own podcast. And I read Nelson Nash's book quite a few times. And it wasn't until I listened to Life Success and Legacy's breakdown of becoming your own banker, where they go step by step, chapter by chapter. They break down the chapter and they use the interpretations of what Nelson was saying. So Mike Everett worked very closely with Nelson Nash, and he had got the ability to ask those questions to Nelson. Hey, what did you mean in, page 5, section 2? And Nelson said, oh, no, that's not what I meant. I meant it like this. And he was able to then teach that to the listeners on that podcast. So I know it was one of their older episodes, but it definitely, that series, I think it was 7 to 10 episodes or more than that, probably, was super monumental for me to understand that. So if you read the book and you want more knowledge, because I think our listeners here are going to want as much knowledge as they can. So by all means, go plug that podcast in. So once again, thanks everybody for joining us. This has been a fun one as always, but these are the exciting ones because we get to dive into really deep stuff. So please continue to stay tuned. We look forward to seeing you on the next show. Take care.
Bye.